Welcome, my name is Sasha Moore and I'm here with Andrew McVeigh, who is the Managing Partner of the investment management business Ramara. Welcome, Andrew.
Great to be here, Sasha. Thank you.
My pleasure. So I'm interested in getting your opinion about the various options for investors at the moment. We're in quite a volatile market and there's a lot of fluctuation and at every level. So I just wanted to get really an overview of where the different investment structures are sitting at the moment and the respective investor appetite.
Yeah, look, to be honest, it's the question that I'm asked all the time. We are seeing what I think is the end of one market cycle and the beginning of another market cycle, and that generally throws up periods of volatility, which is what we're seeing at the moment. It's been really unique to see the RBA increase rates at such the speed that they have. It's something that a lot of people haven't seen for a decade plus, and with that creates a lot of volatility in people's portfolio, and a lot of people are questioning where should they be putting their money, what should they be doing, and it's created a lot of challenges for people. So I think as we've looked at the landscape and the opportunity set, cash is now something that is more appealing than what it used to be, on the basis that the RBA has increased rates, so banks are paying more, and the risk-free rate now means that you can get good yields on fairly risk-free cash deposits. So I think that's changing the nature of what people are starting to expect. We've seen equity markets be quite volatile, and we're not of the opinion that that's going to end anytime soon. I think for the next foreseeable future, we probably would expect some volatility to continue in equity markets. And while there's still dividends and still opportunities, we're not too sure exactly kind of where that will play out and the potential capital impacts to people in terms of share values and whatnot. In terms of real estate, that's a really interesting question. We do real estate investment as well as private credit investment at Ramara. So we are long and bullish real estate, but we do see this as a period where there has been a pullback in values, and we think it's going to hit a period of stabilisation, and then we will see some escalation in values, but it will probably be more subdued than what we've had over the last couple of years. And that's purely on the basis of, again, the interest rate environment and what the RBA elects to do in terms of raising or reducing rates in the near future. And that's where we kind of come to private credit as an opportunity. If you look at credit as an asset class for investment, you've kind of got two, being fixed income or private credit. Fixed income has been very problematic given the raising rates. It had its day in the sun over the last 10 years as rates declined. People got a lot of value in terms of yield plus capital appreciation, and that looks like it's largely starting to come to an end. And there's increased volatility now as there is global synchronization in terms of raising rates, and not everybody's sure what that will ultimately bring. So private credit, as an asset class now, gives investors the ultimate ability to be able to manage a yielding asset that has very little capital appreciation or depreciation. And that's essentially, through the floating rate nature of that private credit, it gives investors the ability to get the yield enhancement above the cash rate, which compensates them for the additional risk taken. It gives them a continuous income yield, but it also means that they're not needing to take capital risk on their fixed income investments. And that's something that I think for investors today is going to be a very valuable part of your portfolio. While you're looking at equities and real estate, there will be capital volatility that occurs in prices, and obviously that it rings true with fixed income with what we've seen lately. But the private credit aspect, given it does move in lockstep and it's generally not publicly traded, so it's not subject to mark-to-markets and things like that, it does provide some capital insulation to your portfolio, and does still provide a very strong return premium and yield based on the risk characteristics of the asset class.
Okay, fantastic. Great overview. Thank you for your time.
Thanks, Sasha.